All right. Good morning, guys. I see that most of you assumed that I wasn't going to be here today. Well, unfortunately, that's going to be your error. I let you know if I feel bad enough. I knew last Tuesday, that I was in horrible shape. I couldn't be here. Uh, Technically, if I tried, I could have taken 2 days off, but I don't want to miss that many classes. I'm serviceable enough I got 2 lectures in me today. Then I'll go home, take my cough medication, which knocks me out, because otherwise the headache that comes from the sinuses, they're killing me. I mean, I took my medication in the morning, you know, 500 milligram of Tylenol, 400 milligram of ibuprofen. That kind of keeps me functional. Since I wasn't well enough to do anything, you're not going to have any quiz on chapter 7 this week, but assuming that I'll be well enough, and I think I will be, my antibiotics started working. You're going to have a quiz on the rest of the chapter 7 this weekend. I'm going to lecture about the part of chapter 7 we're covering this week, the dividend growth, stock valuation using dividend growth model. We'll play Jeopardy on chapter 6 on Wednesday. Next Monday, I'll lecture. We'll go into our standard mode. We'll lecture with discussion with you guys on rest of the chapter 7, and we'll have a Jeopardy on chapter 7 next Wednesday. I think does that take us to the spring break? No, we have one more week after that, right? Or so spring break starts next weekend? Okay, okay. Whatever the calendar says. And I need to know that because I'm actually going to New Orleans uh, almost at the end of that weekend. All right. Stock valuation using dividend growth model. This is a great tool for teaching purposes, but I would never advise you to use that for any trading purposes. In upper level finance courses, investments and portfolio, we actually cover similar stuff, but based on more observable stuff or based on stuff people estimate. Analysts never estimate dividends going forward 5 years, but they estimate earnings. But the reason we're using this, if you remember on bonds, we valued bonds as present value of all the future cash flows that comes out of the security. When I say a 5-year semi-annual bond, there are 10 coupons. We know what they are, plus the face value payment at the end. We have a discount rate. Using that discount rate, we discount all of them, add them up. That's the value of the bond. Dividend growth model uses a similar approach to valuation of the stocks. What's the cash flow that you get from owning a stock? You just get dividends, right? Technically speaking, there are two types of cash flows. From owning a stock, obviously dividends. These are payments. The board decides that they're going to distribute $5 a share, but it is completely discretionary. There is no law that says that any company has to pay any dividends. For example, Google has not paid a single cent of dividends since they were established back in 1998. NVIDIA technically pays a little bit of dividends, but the dividend yield on NVIDIA is about 0.1% or something like that, even less than that. And the other is capital gains. You buy a stock at $10, you maybe got some dividends in the meantime, or you didn't. A year later, you're going to sell it at 15. That's $5 is your additional capital gain from owning that. So we're going to kind of pretend as if this was like a bond. We'll do a simple experiment. We're going to say, okay, buy the stock now at P0. And we're going to pretend that the market price right now is same as the value. Or let's not do that yet. We're going to make a distinction between the price of a stock and value of a stock. Price is what you pay for it. Value is what you get in return. In so-called efficient markets, those two should be the same, but there's no guarantee that they will be. And suppose you hold this stock for 1 year. In the meantime, it pays a dividend of $D1, and you will sell it at P1. Knowing what the dividend is going to be is not that difficult. A lot of times, companies announce their dividend policy full ahead of time, and unless there are, emergency circumstances, they typically pay you that amount. But knowing what the price is going to be is a completely different thing. But we're doing a thought experiment right now. So suppose the proper risk-adjusted discount rate is R. Sometimes we call that the required rate of return. Just like in bonds, the rate that we use for treasuries is different from the rate that we would use for bonds issued by EKU, for example. Why? EKU is more likely to default on those compared to treasury. And there are other things like, liquidity premium and that sort of stuff. But for 1 year, I know what the cash flow is. So value is going to be, I'm going to get $D1 plus P1. I'm going to discount that by 1 plus R. That's so good, theoretically. But the trouble is, I don't know what P1. I mean, I'm basically coming up with a valuation formula using something I don't know. Well, if we take kind of the leap of faith and say, in the future, price of this stock is going to be the value of that stock at that point, right? So suppose we held this stock for 1 more year. So I'm going to get $D1 in year 1, $D2 plus P2 in year 2. So we're going to discount those. I'm going to get this first dividend in 1 year. So discounted by dividing it with 1 plus R. I'm going to get the second dividend plus whatever the price is going to be in year two, in 2 years. So I'm going to discount that twice by 1 plus R. Okay. As you can see, we can continue with this experiment, right? If we keep iterating like this, value of the bond is going to be dot, 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 ad infinitum. As long as that price doesn't grow faster than that discount rate, uh, what that price is going to be doesn't matter. So in that sense, we say value of a stock is equal to the present value or sum of the present values of all future dividends. And I should say expected dividends, because we don't know what they're going to be either. You may have a good idea what the dividends are going to be next year,